Hey, what's going on, everybody? This is Sanchez. I represent Unified Trading Institute, which is an education platform to teach people how to use technical analysis and other methods to make a trade. All right. Now, I want to go ahead and make a response video to the homie Key Sweat, light skin version, a new friend of mine here on Facebook. He has a different perspective on what it is, to use risk management than I do. That's my general consensus. I'm going to go ahead and explain my version here. I've heard his version and watched the video twice. And I do appreciate, the interesting conversation we're having. To me, it's all about, tossing back and forth ideas so that, we can all become successful traders. So that's what it's about. So I won't try to make this video too long, but it is possible that this video will drag out quite a bit. All right, so first couple things, I just want to go ahead and respond pretty much kind of by point and what his video was about. So let me go ahead and start with that. First thing he said was that he's really not concerned about anything outside of major pairs. I'm going to go ahead and toss in minor pairs as well. I'm just going to assume that he's talking about the generic Forex currency pairs that you're able to chart, able to trade. That amount of pairs you can trade is going to depend on your broker. So like for example, my broker allows 60 different currency pairs, but for me, I do have to talk about where zero point zero 0.01 is applicable in the grand scheme of things of everything. Because I teach everything. What I teach is how to read a chart, how to trade a chart. And as long as it has Japanese candlesticks, x-axis and a y-axis represent price over time, then I can teach you how to trade that and be profitable. So I know your preference may not be to use 0.01 lot size because you're only concerned with minors and majors, but I trade much more than that. I trade cryptocurrency, I trade commodities, I trade stocks, and we all know that the lot size is going to be different. Is going to have a different dollar value per whatever instrument you're trading. Even within major and minor pairs, it fluctuates. But we're going to use the general sense of that, 0.01 equals 10 cents a pip and things like that. We're going to keep with that standard, assuming just for this explanation of this video. All right, so the very first point is if you have $100 account, how much you should be risking. How much you should be risking. So I'll start with that. That's a pretty simple answer for me. Let's just go ahead and use 5% for the duration of this video. That's going to be like our foundation number and for this example. So if you ask that a question, how much do you risk per whatever you have, it's always going to be 5%. Again, for this example, it's going to be 5%. So how much is 5% of $100? That's going to be $5. So whatever trade that you enter, you got to make sure that your $5 is your limit. And the whole reason behind this methodology is because it's linear, right? So what I mean by linear, I mean no matter the account size, you want to keep trading systematic and numeratic. That's the best way to eliminate any kind of internal emotions that you may have develop over the course of trading, going ups and downs, whatever. So keeping it number based as much as possible is going to keep you in this game long term. Now, obviously, this is a lot of my own assumptions and way of teaching based off of my studying. Now, I know that I'm new to trading, but it doesn't mean that the people that I've studied from are new. So it's all about the knowledge, right? So it's if somebody was working a career for 20 years and then they teach a rookie how to do it, well, that rookie is going to, in 2 years' time, X amount of time, he's going to have that 20-year knowledge, but in a greater, shorter period of time. And that's pretty much how passing down knowledge works. You cannot be a professional and learn how to do a professional item in 5 minutes based on a Google search. All right, I do it every day because I'm an IT tech. There's just too many issues out there to know how to fix every one. So going to having the ability to research your answer and make a conscious decision is what it's all about, or at least that's what I excel at. Okay, so let's go ahead and talk about the 5% risk and how your lot size is involved in that. So the way to calculate risk management for me is I wrote this stuff down. I'm looking at a board as my reference, and I can go ahead and show you guys that right now. Again, these just a couple little reference points, and I can get close and show you guys, but I do have some numbers there that I want to go ahead and review for you guys. So how do you calculate what to set your stop loss at? You know how to calculate your stop loss because you do 5% of your account. All right. Now you take 5% of that account, that dollar worth. Let's say in this case it's $5. We're going to divide $5 by the pip worth. Okay. So that's going to give us our lot size amount. So if we say that it's all about variables. So if we say that we use zero point zero 0.01 lot size, well, I know that's 10 cents per pip. So I'm going to take $5 and divide it by 10 cents, and that's going to tell me how many pips to set my stop loss. All right. So I did the math, and let's say you have a $100 account, 5% risk is $5. Well, if you use 0.01 lot size, that's going to be 50 pips of traveling distance before you reach your stop loss. All right. 0.02, that's going to be 25 pips before you reach your $5 stop loss. 0.03 is 16 pips. 0.04 is 12.5 pips, and 0.05 is 10 pips. So you can reach your 5% stop loss 5 different ways in this brief example. But the importance is to understand that how your investment size will imperatively determine your stop loss. Okay. So the next point, change life take times. Just to quickly talk about this point, we're all here to change lives, but we're here not to deceive people either. You know what I mean? For me, I've been working for 15 years out of my 29 years of living, right? So the most I've made, we'll just say for this example, is $60,000. Now, $60,000 may have taken me, let's say, 5 years of work to make that amount, but now we want to compare to how long it takes to make 60,000 with trading. Okay. So that's really how you want to think about it. It's not overnight success. It's like, okay, yeah, I've been working for 5 years and I finally climbed my way up to making 60,000, but I can study Forex for 2 years with great leaders and make $60,000 in a year's time as well. You know what I mean? So that's really how you want to compare it. You want to compare how you want to think about it is the long game, is how successful you will be 5 years from now, 10 years from now, because you're willing to work 40 years. So you have to it's only fair to compare 40 years of trading, where would you be at, not tomorrow, where would you be at. So you don't need to use a 0.5 lot size tomorrow. You have to give you time to grow, because you gave your life away working for another man. So you have to think about it the same kind of context. All right, the next point, 4 hours to cash 10 pips. It doesn't take 4 hours to cash 10 pips. Waste of time. So one thing he said that, it's a waste of time using 0.01 per $100. Well, again, it's linear. So you're going to use the appropriate lot size depending on what your balance is. That's a variable number. Okay, it's not a fixed number. So you're going to use 5%, 1,000, 10,000, 100,000. You're always going to use 5% risk. Now, one thing that I offer is not only the financial education, not only the how to have financial freedom, but also have time freedom. So that's the one thing that I'm an advocate about, is time and money, because that's what we're in for, right? If you're only going for 10 pips, you know what I'm saying, that the amount of trades you're going to make a good living is going to be higher than if you go for more pips, and go that way. So that's how I trade. My goal is to take 4 trades a month and make $25,000 per trade. So for me, if I can get $25,000 in 1 week on one trade, you know how much time freedom I have? You know how much time it takes to analyze one chart and have that go for, the $25,000? Obviously, it's going to be dependent on the lot size, but again, this comes to the year's growth. So in 10 years' time, I could be able to make one trade for $25,000. That's going to give me my time and financial freedom. And that's the whole point of it. All right. So it's not a waste of time. How long will it take to make $650 using a 0.01 lot size? I did the math. The answer is 188 days, or 8.5 months. Let's see. And that math is based off of 5% growth every week. So if you have $100, my goal is to get you $105. All right. The next week, it's going to be $111. That account will be $111 total. Each week is going to be gained of 5% interest. Okay. So let's see here. Okay. No secure strategy to get to the next level. So there's a big thing. I don't teach strategies. I teach techniques. I teach people the knowledge it takes to read a Japanese candlestick, because the charts, the Forex market, any chart is not static. You have to be fluid and dynamic with price, because price is dynamic. You can't create a strategy and say if X crosses Y, then enter B at C times D. It doesn't work because the Forex doesn't care. It can do whatever it wants at any given time. So having a strategy, quote unquote, to me is not the way to go. You have to have other attributes. You have to have discipline. You have to have patience. You have to have the knowledge of reading candlestick. You have to have all multiple things to be in this for the long haul. So for me, it's not. I don't offer strategies. I offer mentality. I offer psychologically how to think. So no, I don't use strategies. I'm not looking for one. You're not gonna make any money. That's false. You are gonna make money. You just have to continue to have 5% growth every week, or 5% growth every month. It's patience game. Some people go for 5% every day. It's just all about how you do it. Okay, so next point. He says that on a $20 account, he's gonna put a 0.05 lot size. All right, so let's do some math on this. Okay, so how much is 0.0? So let's say remember our math. How do we determine risk management? 5% of your capital. So what's 5% of $20? That's $1. All right. So let's say that you want to enter a 0.05 lot size. How much is 0.05 lot size worth? That's worth 50 cents. Okay. So you mean to tell me that to reach your 5% risk management of 1%, $1, you're going to put a 0.05 on there? That means you have 2 pips of wiggle room before you reach your 5% risk management. If you go over that 2 pips, that means you're not following risk management. That means you're risking more than 5%. So that's foolish to me. But we all have our different preferences, and I'm not going to knock anybody for their style, but I'm just saying, that's not what I teach. Okay? You have a strategy with no drawdown. You have the Holy Grail. $100 in 30 days. So you ask, what if is people willing to make $100 in 30 days? Well, if you have a $100 account and you make $100 in 30 days, that's 100% profit. So you have to keep it relative terms. Again, it's linear. It's math. Whether it's $100, $1,000, $2,000, it's the same math. So if you have $100 and then you gain $100, that's 100% profit. So if you have $1,000 and then you gain to $2,000 in a month, that's 100% profit. Now we have to compare this to other things in the world, right? Let's compare it to your savings account, where Regions Bank, Bank of America, they're giving you 0.01 interest on a yearly basis, and you're telling me that a 100% increase isn't good enough for you? That's the level of thinking that I have versus what you have. Okay, so now the next point. He thinks that you need to make 100 trades to be profitable. Again, you don't. You can make 4 trades a month and be profitable. 80 pip stop loss. That's okay. You can have you can manage your trades to allow 100 pip stop loss, 80 pip stop loss, but just use your risk management. I always teach 3-to-1 risk. So if you're risking 80, you want to go for 240. So that if you lose 7 times at 80 pips, you can win 3 trades at that 60 pip mark, or at the 240 mark, and be more profitable. Losing 7 trades and be profitable. Again, it's linear. So it's $100. I'm not gonna beat the bush. So again, yes, you can still be profitable with an 80 pip stop loss, and people can plan for 80 pip stop loss and still be profitable. I know a lot of people who will go for 100 pip stop loss, but if it goes in another direction, then they're in profit. You know what I mean? And they're going for much bigger trades. We're not going for 10 pips. That's not the way. There's nothing wrong with it, but that's not how I do it. Next point. There's people that can do 30-day challenges of $100 to $10,000. That's funny. I did the risk on that. I did the math on that. That's 17% growth every day, or 85% growth every week. Again, why? Just why? That boggles my mind. How is it possible? That's deceiving and that's deceit, and I don't agree with it and I don't support it. I'm not going to teach somebody to go for 17% every day, 85% every month, every week, when their bank is only giving a 0.01%. You have to think about it in relative terms of other investments. This is a career of investments and returns. It's not gambling and hitting a lever on a slot machine. 24 trades to a million. LOL. I didn't say that you're out of your mind. You mentioned that I said you're out of your mind. I didn't say that. I didn't call you anything, to be exact. If I was to call you anything, it would be a gambler, because I'm not going to go for 2 pips on a trade. I don't risk my lot size for 2 pips. That's not the way I trade. You've clearly stated that's the way that you trade, and that we just have different opinions there. All right. Next thing we're going to talk about. You said even with $50 that you're going with a 0.10 lot size. So we can do some math. All right, 0.10 lot size. What is that worth? $1 a pip. So 5% of $50. Let's just make sure I'm right on this. Let's do some math real quick. What's 5% of $50? Oh, come on. I have the math right here, but I want to make sure I'm telling you accurate information. So let's say $50 times 5%. That's $2.05. Okay, $2.05 is your 5% stop loss. Okay. Now, how much is a 0.1 lot size worth? That's worth $1. So you got 2.5 pips of movement before your 5% is reached. Again, the math is linear. No matter what number you throw out there, your risk level is much greater than what I'm willing to risk. So don't go for that kind of growth. Twin trading, I don't trend trade. I don't try to beat the market twice. I'm not smarter than the marker. I just want to. The whole thing is the market. I'm not smarter than the market. So twin trading, in my opinion, is you're trying to be better than the market twice. There's a time and place for it. If you're up 20 pips in a buy, then yeah, you can grab a 20 pips with stop on a sell on a retracement. But I'm not going to be plus 15 and minus 10 at the same time. I'm just not going to do it. It's not the way that I operate. It's a way of as another form of gambling for me. You say if you want to be successful, you got to do it for yourself. I don't do it for myself. I do it for others. The whole point of me reviewing this is because I want to change your guys' thinking. I don't want you to continue thinking that it's overnight success. Start thinking about tomorrow's success. You also you also mentioned that 3% of a count is 0.01 lot size. That's not how you calculate risk management. I already explained how to calculate risk management. That's not how you do it. So let's go ahead and run by some numbers. And I'm going to go ahead and turn the camera around so I can show you guys this. Let me see if I can. Let's see if it'll turn around. It's not going to turn around. But basically, here I'm going to go with some quick math. And I can show you guys the screen here. Alright, I hope we can see it. So we got here on the screen, on the board rather, 22 trading days are in 1 month. This is free sauce for you guys. Take it with you. 22 trading days are in 1 month. 264 trading days is in 1 year. $100 at 5% growth, at 5% weekly growth, is going to be $1,382, $1,382 in your first year of trading. Your $100 is going to be $1,382 in your first year. All right, it